Joining us now from Los Angeles is Michael Nemeroff. He's president and CEO of Vedder Price. Michael, thank you for joining us. I understand you think 2020 may be a pretty good year for deals, but maybe not the best year. What do you think of the setup here?
We think that 2020 is going to lag 2019 for a couple of reasons. One, you've been talking about it all day. The high market valuation coupled with slow earnings growth is not really a juicy environment for big deal M&A. And you have some unusual features in the U.S. economy, political risk. If a progressive wins the presidency or Congress, that might change the viewpoint of corporations across America in terms of growth in M&A. And you have some regulatory uncertainty on the antitrust side, all of which backs up on large deal M&A.
Well, just pausing and reviewing 2019, what was the key factors behind some of the big deals, even if they were across different sectors? What do you think triggered a lot of the big deals?
Well, number one, you had great reasons for corporations to buy growth. Earnings growth is slow to come by, so large deal M&A helps with growth quite a bit. And with stock prices high, stock is a very attractive currency to use for deals. That's definitely number one on the large deal side. The second thing is PE firms have hordes of cash. There's more cash in American PE funds than ever before, and that offers valuable currency. And the third piece is the constant drumbeat of activist investors who are causing M&A through their activity by pushing companies to either divest of big businesses or sell themselves generally.
I guess most of those factors still apply. I mean, diving into the PE and activist investor point, do you expect that to continue? And does it start to suggest that some of the deals those types of investment companies might be doing are not as attractive as they were a couple of years ago?
Well, certainly with the high prices, that makes PE investments a little harder to come by in the public space. You have to pay more for the companies. The leverage is increased. The credit markets aren't quite as open as they used to be. So certainly that's a factor. That's not going to change. There's still plenty of cash available. With the higher valuations, that should slow down deal activity a little bit. We still think 2020 will be robust, but not quite as robust as 2019 or 2018.
When you look at the different sectors, is there one that stands out to you as potentially needing to look at deal making for growth? Maybe it's an old name that sort of needs the pizzazz of a younger company that just doesn't quite have the expertise to get it there. Any combinations there in sectors in particular you're looking for?
Well, we think that you'll continue to see technology being needed by old-line companies to stay more relevant. So a PetSmart buying a Chewy is a good example. McDonald's acquiring voice recognition technology around its drive-thrus. The large motor companies like Ford buying autopilot sort of technologies to compete with Tesla, and companies with autopilot sort of ability to self-drive, all will continue in a major way, we think, in 2020 as a business necessity, regardless of the other factors we've been talking about, like valuations and things of that nature.